Valens Research, Uniform Financial Analytics.
Workday is really interesting because this, again, just highlights how wrong as reported accounting metrics. We'll come back to the PVP for for Workday. But first, I want to focus on another tab. This tab here is actually, I didn't mean to go to this tab, sorry. I meant to go to Uniform Accounting EPS tab. What this tab shows us is what the uniform and as reported EPS for Workday is, and also how the market's valuing Workday. You look at Workday and you think that Workday is losing money every single year. You think that Workday's EPS in 2018 was negative $1.50, and that actually they lost more money in 2019 than they lost in 2018. Workday didn't actually see returns inflect. Workday saw EPS drop from $1.50 a share loss to $1.90 a share loss. In reality, you couldn't be more wrong if you were looking at the as reported metrics. Workday's EPS actually rose from $1.50 to $2.30 of positive earnings. And all of a sudden, then when you look at a company that's trading at a 70 times multiple, which sounds mind-blowing, but you understand that kind of growth, it makes sense. Like a company that's trading at 123 times multiple with negative earnings would never make sense, right? What are the things that are causing the distortions here that's causing the as reported metrics to be so wrong for Workday? Well, we can see because we give you a reconciliation for every single company on what is so wrong with as reported accounting metrics. The impact of adjustments tab here shows you how do we get from the wrong net income number and the wrong total asset numbers for Workday to the real uniform accounting adjusted metrics for both adjusted earnings and adjusted assets. And you can see there's two huge reasons for Workday. One, non-cash stock option expense, which turns invest managers into shareholders and conserves cash for the business, is massively incoherent for that to be on the income statement. The bigger reason why, by the way, it's massively incoherent for stock option expense to show up on the income statement, it's not actually about compensation. Do you realize what most of stock option expense is? It's not management getting paid in stock options. It's changing the intrinsic value of those stock options that management has already been granted over the last few years because of how the stock price has moved. When the stock price moves, according to Black-Scholes, volatility increases. That means the value of options that management has already been granted changes in value. Does that have anything to do with the operations of the business? Of course not. And yet that causes earnings to be negative $400 million last year for Workday. On top of that, Workday is investing in R&D in the future of the business. Did you note the word I used there? Workday is investing, right? R&D expense is not an expense, it's an investment. And when you have a company like Workday that's spending more on R&D each year than it did the year before because they're investing in the future, they should be punished for that. If anything, that's a value-added investment they're making in the business that should show up in the balance sheet. Instead, just like we do for depreciation, we should be treating R&D as an investment that we then amortize over time. Because of how much more they're investing in the business, as reported accounting metrics punish them and say that they actually are spending way more in R&D when actually that's an investment. When we make those adjustments, we see earnings for what it really is. And what we realize, coming back to the PVP, is that Workday is not a company losing money whose returns dropped from negative 4.5% to negative 5% last year. Workday is a company that's been making money since 2015 and returns are steadily improving, right? This is a software business, a services business that is hugely profitable. It's generating a 17% return. By the way, what's also incredibly powerful is when we look, what we can see is the market is only pricing in returns to stay flat for Workday when returns have expanded for 4 of the last 5 years. The market's expecting returns to be flat, and also this company that's been growing at 40 to 60% a year the last couple of years, the market's only pricing in 30% growth, right? The market is basically saying you've reached your return plateau and you're going to slow growth. Now, is that right or is that wrong? I don't know. We don't have an opinion on Workday. Does it make sense? Yes. Could I have this conversation with you if I was looking at distorted as reported metrics? No, because I would be telling you that Workday is losing money and you should be avoiding this business because they've had 7 years to figure out how to make money on the scaling business, and they're already trading at a $40 billion market cap when they're losing money. I would directionally wrong have opinions about Workday. And look, it's telling that the market is paying way more attention to the uniform accounting metrics that are actually improving, right, from 2017 to 2019, than is paying attention to the as reported metrics. Why? Great investors understand there are problems with as reported accounting metrics too.
Valens Research, the world's leading source for uniform financial analytics.